at some point.
Yay!
All right.
Hey. All right. We're a little late.
Microphone's all the way on.
Okay. Good?
Yes, you're good. Just
All right.
do your thing.
All right. Okay. So, sorry that we're late. Little technical issues getting everything hooked up, but we are all good. So tonight, Marie didn't talk to me about what you wanted me to talk about.
What?
So
Do your thing.
I was like, hey, we're just going to go. We're going to talk about 5 years to freedom. That's something that, that I've kind of been promoting, that really anybody can achieve 5 years to freedom, meaning financial independence with real estate investing within 5 years. And so that's what we're going to talk about tonight. So I'll tell you a little bit about my story, but first, I want to ask everyone this question. This is a question that I asked myself back in 2010 after I'd been investing for about 3 years and kind of, I would say, failing forward. Made my first investment in 2007, and then 2008 hit, and I found myself with, I think I had 5 units, all underwater, all cash flow negative. And I realized that I was kind of doing it wrong, essentially buying for appreciation and not for cash flow, and I've since, of course, changed that entire strategy. But really, I sat down, my husband and I were on a honeymoon in Fiji when we got married in March of 2010, and we were dead broke, completely broke. And so we couldn't actually leave the hotel because we didn't have money to go on any kind of excursions. And so we sat down on the beach with again, we couldn't really even afford to buy food because Fiji was incredibly expensive. But we just mapped out what an extraordinary life looked like to us. And at the time, my husband was working for the union, making over 6 figures. I was a newly licensed real estate agent, literally had my license for about 6 months. And, we just kind of put our thinking caps on and thinking about what would an extraordinary life look like to us. And so we set this goal, and at the time it seemed completely unachievable based on the negative equity and all these rentals that we had that were cash flow negative. But I said in 5 years I want you to retire. So he would have been 30 years old at that point, so we were pretty young when we first got started. And I said I wanted to have $1 million in net worth. And then I said okay, so what does that mean to us? Well, with $1 million in net worth, we would be able to travel the world. And with all of these rental properties, they would be paying for all of our bills, meaning that he could retire. Again, we'd have a net worth of $1 million, and we'd essentially be able to have freedom with time and money, which at that point we had zero freedom, zero money, cash flow negative, and negative net worth. So I really want you guys to think about this, because a lot of times I think we just do life kind of by default, or essentially we're not really sitting back to think about what we want our life to look like. We're in this busy mode, especially, again, I was a real estate agent, which is hey, it's whatever fires I need to put out that day, I'm going to go jump into that. And there really wasn't a whole lot of thought and strategic planning around what we wanted our life to look like. So that's really the first step for everyone, is to really design your ideal lifestyle and think about what that looks like, because then you're going to make very different choices, which is really, we're all defined by our choices on a daily basis, and then on a weekly basis, on a monthly basis, quarterly basis, yearly basis, lifetime, right? And so this photo that I have, I'm not sure if you that are watching from home can see this. This was a dream of mine. So this is my bucket list. In 2010, when we were broke, worse than broke, had no money, and I said, on my writing out my extraordinary life, I said I want to take our children, which we didn't have children at the time, to Egypt. I want to ride camels. I want to tour the Pyramid of Giza, and I want to be in Egypt making passive income. Essentially meaning that we didn't have to show up to make money, but I wanted to be in these different places all around the world and making this money. And so literally we were just in Egypt in October of last year, so not too long ago, was that 7-8 months ago, in Egypt with our 7-year-old daughter, who's now in the business. I'll talk about what that looks like in a minute. My husband's been retired for about 6 years now, and essentially we've built a system. Not necessarily, I see ourselves very much as investors, not as self-employed people, which is the hat that I was wearing as a real estate agent. which, as we all know, if you're self-employed, what happens if you don't show up in the business? Does the income go up or go down? It doesn't come in, right? So Robert Kiyosaki's cash flow quadrant, you have the employee, the self-employed, the left-hand side of the quadrant, which is, I would say, what we're taught in school, what we're taught in college is to be good employees, follow the system. Eventually, hopefully, we can retire at 65 years old. And that's really ingrained in us in a very, very young age. Be good students, go to college, get a degree, go into student loan debt for that, and then, eventually, maybe you can retire and then live the life of your dreams. Well, in my opinion, that system is completely backward. And it's actually, in my opinion, non-relevant. It doesn't really work today based on the economy that we're in, based on the inflation that we're all seeing, right? A lot of families are unable to survive on one, even dual income right now, right? And so we need to be investing in income-producing assets that are a hedge against inflation, that go up with inflation, the asset value, and also the income, right? So that's the best thing that you can do in an inflationary period is to have income-producing assets. And so, so that's really the first step. And then the second step is I see a lot of investors, I get a lot of investors asking questions like, how to do this? How do I do this if I don't have any capital? How do I find deals? How do I invest in properties? How do I do this if I don't know anything? How do I get started? And my feedback to that is avoid the tyranny of how. Meaning so many people get stuck in the how. And I want you, anytime you're feeling like you're stuck or maybe you can't get to the next stage, replace how with who. And so this is a really meaningful picture to me. My husband is behind me. We've got a couple of other people that currently work for me in my business that run the business while my family and I travel. We travel about 3 to 4 months out of the year, meaning don't show up in the business. Money still comes in because we own a system and a process, not a self-employed job, right, that most of us are working in, or employee. And here's my real estate agent and her husband. And so this real estate agent, a lot of times people say, well, how do I find the who's? Which is a great question. But the little redhead here, that's Kelly Kellett. I had identified, which I'm going to share with you guys, how to identify markets to invest in. I'd identified a market just outside of Nashville called Clarksville, Tennessee, that had 50% population growth over the last 15 years. Kelly is my who in Clarksville, meaning she feeds me on and off market deals. I own a couple of apartment complexes in Nashville that have, I think I have over $1 million in equity just in Clarksville alone. And so, again, I share this photo because I want you all to stop asking how and instead replace how with who. Who can I find that can bring the capital to invest in the deals that I want to invest in? Who do I need to align myself with that thinks differently, that is focused more on the investor, the business owner side, so that I can get the freedom that I want, so that I'm not living on the left side of the quadrant. All right, so now that we're past that, I want to give you guys some really tactical advice and feedback on actually what you need to be focusing on. So there's really, in my opinion, there's 4 areas of focus when investing in rental properties. Number 1 is finding and underwriting deals. So I have this fun little graphic that points there. If you do anything in the business, it's really to master finding and underwriting deals. So currently, I would say I get anywhere from 10 to 30 deals a month in my inbox that all come from my who's. And so for me, finding the deals is actually pretty easy because they just come to me from my who's. It's all about the underwriting. So I would say 80% of my time is spent underwriting deals. And then number 2 is finding the capital. So for those of you that are thinking, this sounds great, I'd love to be in Egypt with my family within 5 years and have the freedom and time to do that, but I don't have the capital. I didn't when I first got started either. And so my who was investors that I brought into the deal, gave them 50% of the profits, but I focused on finding and underwriting deals. That is all that I focused on. But I knew that if I could find really great deals, finding the capital, that's the easy part. And I would say that today in 2022 is a lot easier than when I was starting out in 2010 because the market's very different. Investors were very scared. to invest in these kinds of deals in 2010 because we were in a deep, deep recession. A lot of the banks had just went under. So it was really, really easy for me to find great deals and then pitch those to investors that had the capital because of my confidence in the deal and my ability to find and underwrite really great deals.
Okay, super quick question.
Yes.
So repeat it so they can hear
Yes.
it. Were these commercial properties, single-family rentals, or what kind of properties were they?
So I got started with development.
Like building.
Building new construction. Yes, because the market, so I come from Seattle, Washington. I was investing about an hour north of Seattle, and my skill set at the time was actually
She has a microphone.
was actually new construction. And so my very first deal, actually my first partnership, my first JV deal, and my first deal really as like an agent and as an investor was a 4-unit new townhouse development. And yeah, so my first 5 listings also as an agent was new construction. And so essentially I raised the capital, it's about $750,000. I think we ended up selling out that project for maybe $1.1 million, so new construction. And I wish we would have put renters in them as opposed to selling because it's probably worth a heck of a lot more these days. But yes, Liz's point was basically you have to get started somewhere. So my advice would be start small, start now, get started. And so then number 3 is finding the financing, the credit, and the net worth. So there's a lot of opportunities right now. When I got started, there was like 0 option for financing. It was like none of the banks wanted to touch new construction. There were some conventional loans, but on investment properties, the terms weren't great. I think the interest rates were like 6% at the time. Rents weren't very high because people were staying in their houses and essentially like not paying their mortgage versus paying rent. So I would say that a lot of people say, I wish I got started when you did. And it was actually more difficult, and I truly believe this, it's more difficult to get started in 2010 than it is today. Even though the prices were less, the prices were cheap, but the rents were really low. There was like no liquidity in the market. Nobody wanted to finance any kind of investment property. And then again, the investor sentiment, there's just not a lot of people that wanted to lend capital to these projects. So everyone has it really easy right now. It's very easy to raise capital. And then number 4 is operations asset management. So great operations, I'm going to show you guys a demonstration on this, on how you can essentially force appreciation on your properties when investing in multifamily. But this is another area of focus now. My husband is our asset manager. So he manages our entire portfolio. We have properties in 8 different states, about 265 units. And he pretty much manages that himself, managing property managers. All right, some tips for finding and underwriting deals. Number 1 is working with investor agents. We have multiple agents.
Can I have you back up
right
for
now.
1 second?
Yeah.
Can you explain why asset management is like only managing property managers and like what's the difference between asset management and property management?
Yes. So the question is, what is the difference between asset management and property management? So if we go back to the cash flow quadrant, in my opinion, property management, that is in the self-employed category, right? You own a job. And the asset management is, it could be argued that it's either in the investor side or in the business owner side. We have systems and processes that we've put in place in our, I would say, in our rental portfolio business that essentially allow us to spend very little time. My husband probably spends, I don't know, maybe 1 to 2 hours a week asset managing our portfolio versus the property managers. I don't know how much time they spend, probably a lot.
Yeah.
Now, I would say, again, I spend the majority of the time finding and underwriting deals. And so, by the way, if anyone is looking to put together a partnership, you can bring in maybe 2 partners. You can do this all your own. I've done all of this on my own, basically wore all 4 hats at one time. I don't suggest it. But if you're looking to really scale up, you need 4 partners that do all of these things in these 4 areas of business. I'm currently in the process of putting together a fund which will buy lots of different properties, and essentially we're building a org chart that includes all of these, right? And so really, so asset management and operations, I put into that category legal, You've got your CPA, the bookkeeper, all of that reports to my husband. And his goal is to drive NOI. NOI is net operating income. What happens when you drive NOI?
Everyone's income goes up.
Yeah, oh, I love that. Everyone's income goes up, right? So yes, you pay a pretty penny to my CPA.
Yeah.
Every additional state income tax return he has to do when we buy more properties, he makes more money. Our attorney makes more money. But essentially, when you drive NOI, of course, we make more on the cash flow, and then the asset value goes up because it's worth more. It's producing additional income, right? And so, for me, again, I need to find value-add deals. I find the capital, I figure out the financing, and then he asset manages. So, it's kind of how that works. But that's the...
By the way, you've got 7 people on live right now.
Oh,
So I know we don't have a lot of people here, but we have 7. That's like a record.
Awesome.
Yeah. So we got people
Hey,
on
y'all.
live. It just jumped up to 9. So
Awesome. Oh, 9. I love it.
That means people can hear you
Great double
too.
digits.
Perfect. Yay.
That's a big deal.
Awesome. All right, let's talk about finding and underwriting deals. Number 1, work with an investor agent. Does anyone know the difference between an investor agent and a regular residential agent? Liz, what is the
Wow,
difference?
I mean, I don't know if they can hear me, but I mean, Mia is an investor agent.
Yes.
She understands our language, she understands what we're looking for, and she understands why we're looking for it and the deal. And she's not thinking, oh my God, you're just out there to, you're killing me here. It's that. She understands the deals.
Yes.
You win when you buy the property.
Yes. I love it. So for those that maybe didn't hear, the difference between an investor agent and a residential agent is the language that they speak.
Yeah.
Right? So residential agent is going to say things like, well, this is a really nice neighborhood. And the school district is great. And look at this 2-car garage. And the neighborhood is really crapped up. An investor agent is going to say things like, well, you're buying at this cap rate. Your exit cap rate could be this. Your price to rent ratio is this. It's a completely different language.
Bulldoze it and rebuild it.
Or you can bulldoze it and rebuild it, right? That's something that you wouldn't find a traditional residential agent. They don't think like that. Meaning, we could potentially look at the same deal and come up with 2 different outcomes. The residential agent might say, oh, you could live here and it'd be really nice, and maybe the home will go up in value. Whereas the investor agent will say, well, you have a couple of different exit strategies. Number 1 is you could put a short-term renter in here and get 22% cash on cash. Or you could scrape it, and your net profit could be X. Or you can do these different things, right? So it's looking at a deal from a different lens. So for me, I only invest in multifamily properties, so it's a little bit different. Residential agents tend to not know multifamily properties, which I love. By the way, I love it when the listing agent is a residential agent and they just don't understand, because then we can come in and negotiate a really great deal for ourselves in great terms. But essentially, work with investor agents in the markets you want to invest in. We're going to talk about markets here in a minute. Liz already said, price is everything. Guys, you make money on the buy, not on the sell. Right? So let me say that again. You make money on the buy, not on the sale. Right? And so price dictates how well you will do. Right? And I get it. Today, deals like real estate's overvalued or maybe overpriced, but honestly, guys, I'm telling you that it's not. I probably write, 5 to 10 offers a week. And so, and every other investor friend that I know that owns 50 to 100 units, everyone is writing offers right now. Why? Because we still feel like the real estate market is actually undervalued. Some markets, I shouldn't say every market, some markets are still undervalued. Number 3, value add. So every single deal that I buy, I have to answer this question, where can I add value? I typically don't buy new construction. I typically don't buy A-class. Because typically there's not much value to be added, meaning that there's no meat left on the bone. And so that usually means that the returns are lower. That also means though that the risk is less, right? So the more that I get into deals that have, high unit turns or maybe low vacancy, low occupancy, high vacancy, that's more risk, right? But there's more return. And then condition. So condition dictates the price. And then it'll eat all of your cash flow if you don't budget appropriately. I've seen a lot of investors get into markets like Detroit, Birmingham, Little Rock, Cleveland, Ohio. They think that they're doing value add deals, and the condition eats all of their cash flow. I see this a lot. It's same with D-class, right? So essentially you're buying poor units, poor condition units that need a lot of renovation. Maybe you get a tenant in there that hopefully will pay, but by the time they leave, you're eating an entire year's worth of cash flow fixing up that condition, right? I see investors do this all the time.
You scrape and rebuild, Leanne.
All right. Yeah, so that's where if you're in a good market, you scrape and rebuild, you start over. That's okay. So my market criteria, so as mentioned, I'm invested in 8 different states. So I don't want to invest in any markets or cities that have less than 20,000 in population. So you might see a lot of deals out there that, we have a great agent in Texas and he sends some deals in like no man's land that have population 2,000. Because you're never going to make any money on that. I'm telling you, stay away from the really, really low population markets. I use city-data.com for that. I also look at population growth. So I mentioned, I think I threw out Cleveland, Detroit. Yeah, ideally 30, at least 30% population increase. But yeah, Detroit, Cleveland, no. Yeah, that'd be like, I would say over 10 years.
Okay.
Yeah.
So I have a question about your number.
Mm-hmm.
20,000 sounds really low
The small.
for population. So
Uh-huh.
where did you come up with the 20,000 number instead of, 500,000?
Yeah, well, so keep in mind, so that's the city, right?
Okay.
And so that's the city. And so what I like to do is I actually like to find the large cities that a lot of people are moving to and draw a 1 hour radius map. So Nashville, Tennessee, one of the fastest growing areas. Very expensive, very low cap rates. But you draw a 1 hour radius, and I found this Clarksville, Tennessee that has a 50% population growth, population 285,000. And so it's like, okay, never heard of that before, found a commercial agent. She found me some great off-market deals. But yeah, I would say minimum 20,000. There's some areas, when you get into the South, the way that they kind of segment their cities, I would say Phoenix is really interesting. Because we have the valley, and then it's like no man's land for a bit. And so this is kind of, like, I consider this kind of similar to like Boise, which is like island in the middle of nowhere. And then you've got like no man's land for a while. But when you get into the like northeast is a little bit different because it's high population density. But when you get into the south, there's some towns that have higher population growth, but lower population numbers, right? But let's look at like Queen Creek, Santan. Some of these areas, obviously they have larger population than 2,000, but I think Queen Creek, for example, population like 10,000 maybe 10 years ago. And I mean, just massive population growth. And so, yeah, so for me, 20,000 is the minimum. And so I pretty much, anything less than that, it's, in my opinion, it's a lot more risky. Right? It's going to be really hard to drive the NOI and get that appreciation. Number 2 is high potential rent. So I don't invest in markets. I typically use the 2-bed, 1-bath. As like 800 square feet. Anything less than 700 on the average rents, I'm going to pass on. Because again, it's going to be really, really hard to drive those rents up. And so that's kind of my minimum. Now, it's okay if the seller is getting less than that, but I'm looking at fair market rents. Right? So I'm looking to buy in maybe at 700 or 800 and drive up to like 900 to 1,000. We're seeing that a lot of times people say, well, how do you get from 700 to 1,000? And it depends on how long the seller has owned the property, right? So we've seen massive rent appreciation in a lot of different markets, and a lot of sellers that are kind of retiring out of being a landlord, and essentially they just have lower than fair market rents. And so you really need to know these rents. I look at Zumper.com. That's my website for looking at rent appreciation. They'll break it down by the city. They'll also break it down by neighborhood. And so you can find in certain areas, like St. Louis is one that I'm investing in right now, high population, high potential rent appreciation, but only on the south side, not on the north side, right? Really obvious to me with Zumper and also my commercial broker. He says, look, everyone wants to live south of Del Mar Boulevard. North of Del Mar Boulevard, that's kind of where crime happens, no rent appreciation, don't buy there. And then I also look at job growth. I look at the Department of Numbers, which publishes a monthly report on the job growth. So I essentially use this to kind of identify markets. Las Vegas has been at the top, of course. We're here in the Valley of Phoenix. High, job growth numbers. San Antonio is doing really well. Austin, Texas, of course. But yeah, this kind of helps me determine which markets I should be looking at, and then essentially I go and build a team around that. My favorite markets right now for appreciation, of course, Phoenix. Seattle, I still have 7 or 8 properties left in the Seattle market. Boise is great for appreciation. Not so great for cash flow though. So again, every investor has a little bit of a different criteria. And then number 2 for cash flow, love St. Louis. Great double-digit cash-on-cash return almost from day 1. Really easy to drive those rents up. Columbus, Ohio. Columbus has a lot of money coming in right now.
Born and raised here.
Columbus gal. I didn't know that. Amazing.
I didn't know that.
This is from Columbus.
Oh, wow.
In here.
OH.
And then Western Michigan is another kind of really interesting market that has great cash flow right now. Grand Rapids is really, really, I would say the prices are still pretty low, so the price to rent ratio very high, but great for cash flow. And then total return, in my opinion, it's in Tennessee. Love Tennessee. Tennessee is, of course, one of the 7 non-income tax states. I've been investing in Clarksville for a while, and also Chattanooga, Tennessee. Chattanooga is in kind of that tri-state region. So a lot of people from Atlanta moving up to Chattanooga get the non-income tax.
What do you mean non-income tax? Like they don't charge at all for income?
Correct. Non-income tax state.
Wow.
Washington, Nevada, Wyoming, got Alaska, I think, and Tennessee, Florida, and then maybe Hampshire. But yeah, total return meaning the combination of cash-on-cash return and appreciation. Love Tennessee. Tennessee has massive inward population migration, so those are 2 of my favorite markets there. So deal analysis 101. So if you're saying this all sounds great, but I have 0 clue how to analyze deals, really it just comes down to income, expenses, debt, and capital. Everything pretty much falls into those categories. Most of the time, expense ratios are going to be between 25 and 50% the gross scheduled income. So even if you have, like on the multifamily side, if you're lacking financials from the seller, which I get all the time, you can pretty much do it on the back of the napkin. Meaning, like, what are the expenses? 50% is going to be on your, larger multifamily and or maybe your older properties. It's going to just have higher expenses. Number 3 is you need to know what NOI is. Basically, it's income minus your operating expenses. So keep in mind, operating expenses does not include debt payments. That is completely separate. So examples of operating expenses are going to be your property taxes, your insurance, your property management, any utilities. Those are operating expenses. Debt coverage ratio is that's what they use on the commercial side. Basically, how well you can cover the debt. So debt meaning principal and interest, right? So again, property taxes, insurance on the residential side, if you're used to that, that is included in the operating expenses. Debt is just considered your principal and interest. So a lot of commercial lenders are looking for debt coverage ratios of 1.25, meaning 25% more net operating income than your debt payment. Pretty easy to calculate, easy to figure out. But it's just your net operating income divided by your debt payment. So Phoenix, for example, really tough to get that 1.25% debt coverage ratio. Right?
Yeah.
So what that means is you have to put more money down. Whereas I'm looking at deals where my debt coverage ratio is like 1.5, 1.6, right? Meaning that my net operating income would have to go down by 50% to break even. Those are the kind of deals that I love, right? Cash on cash is your annual cash flow. So that is your net income after factoring in your income, your operating expenses, and your debt payments. And that's divided by your total initial investment, right? So for really easy math, $100,000 investment to make $10,000 a year, 10% cash on cash. Pretty easy.
What would you say is a good cash-on-cash return?
Minimum 8%. Yep. Minimum. I go for the double digit. It's not worth my time. Unless it has double digit cash on cash. And then so number 6 is when you're looking at multifamily. I love multifamily because the new value is always going to be determined by the net operating income divided by the market cap rate. So residential, we own a duplex and we want to refinance. The appraiser is going to use the comps in the area that are duplexes, similar size, similar year built. They're not going to account for if we have good operations, we have higher rents. Doesn't matter. Multifamily is the exact opposite. So multifamily, they're not going to necessarily look for comps. They're going to use your net operating income and a current market cap rate. I'm going to show you guys what this looks like. This is a deal I bought 4 months ago, and I've already improved the value by about almost $50,000 by increasing the rents $525. So this is in Western Michigan. It's in Holland, Michigan. I purchased this property for $775, and I received a $15,000 credit at closing. The cap rate in this market is 6.25, so pretty good. Current market rents were about $800. Fair market rents are $1,200. Pretty big discrepancy there. So what we do a lot of times is we try to, I would say, push the rents without doing renovations. So what we did is we said, all right, tenants, new sheriff in town, new property manager, new owner, and we raised the rents to $975. So we got about a $525 a month rent increase over all 7 units. So my new value when I applied the 6.25% cap rate is $820. So you guys see that, how I got 50 grand? If it's on the residential side, you have to wait to see if anyone else sold, and then maybe if you have higher comps, maybe you can find that 50 grand. But here's the really exciting part. I'll tell you real quick. When I get $1,200 a month in rents, then this property is going to be worth $1,055,000. So do you guys see how quickly? And I could probably get there. I don't want to kick any tenants out right now, but I could probably get there within 12 months. So essentially, I force appreciation. My cash and cash, by the way, today is 12%.
So you're going to raise it as people move in, you'll raise the rent, or do you think you'll shock value them and raise it all up?
Yeah, so we thought that some tenants would leave at $975. Nobody left, which meant we probably should have done $1,000. So we're doing 0 renovations. We got $800 to $975. Nobody left, which I was kind of disappointed.
$975.
Nobody left.
You raised $175 a month?
Nobody left. Yes.
So are you legally allowed to do that in that state? Because
Yes.
I know in Arizona you're only allowed to increase it like 10% at a
Yes.
time.
So I don't invest in rent control areas. No, keep in mind these tenants were all month to month, and they were all paying less than fair market value.
Okay.
So
And
the
they had
owner,
month to month.
they were all month to month. The owner had owned it for like 10 years, never really did much. They were clean units. This was built in 1985. This to me is a vanilla deal. I don't want to show you guys the best deals because then that's going to set the bar really high.
Yeah. Are you making them sign longer leases, or are you still letting them be month to month at $975?
So we're letting them be month to month at $975 because I actually wanted some tenants to move out because I wanted to renovate those units.
And then charge.
Yeah.
Yeah.
Yes.
So you can rate it as it again.
Yes. And so if nobody leaves before the end of the year, for tax and cost segregation purposes, which that's a whole nother conversation, and you guys should read a book about this. So I'll let you guys read the book. But I'll probably go in and I'll probably pay about $7,500 a unit, but to get from $975 to $1,200. And again, see the benefit of when I get to $1,200, $1,055,000. Right? So do you think that I want to get there?
Yeah.
Yeah. But today, hey, if like tenants want to pay an extra $175 a month, I'm going to take it. But when they move out, that's when we're going to put the money into this place. We're going to get the rent to $1,200, and we're going to turn up the heat to the other tenants until they leave.
How much do you think you have to renovate them for? Do you even know?
$7,500 a unit.
Okay.
Yeah, pretty easy. Now, I didn't even apply a midterm rental or short-term rental. Again, that's a whole nother, like, if I were to midterm some of these tenants and some of these units, meaning I put furnishing in, and I rented them out on maybe 3-month leases or 30-day leases,
Furnished.
then I could get over 20% returns. Yes. But again, I want to show you guys the, like, vanilla, like, this is a so-so deal to me. But this is what gets really exciting. And so I can go back to this property in 12 months if I wanted to, get all of my money back. So I think I put, I don't know, maybe $250,000 down or something on this one. I can get that back, roll that into another property, and keep recycling that. I'm going to buy another one of these vanilla deals or better. Was there another question? Did you actually?
How many units is that one?
This is just 7. Yeah, 7.
Are you doing it with an investor?
No.
Just
No, this is actually a 1031. Yeah, so I bought this 1031. But I'm going to show you guys another deal of how you can do it with an investor. Cool. All right. So here's another one that I buy. I'm closing on this one in a couple weeks. This is a 14 unit, purchase price 1.1 million. Cap rate on this one, it's pretty turnkey. But the rents are a little bit low. We're about $2,000 a month under fair market rent. So when you apply the same cap rate, buying in at 6, but getting the rents higher, the net operating income higher, because we all know in commercial, it's based on the net operating income, right? We're not changing the cap rate. I'm not going to do anything different with that. It's going to be worth $1.4 million. So essentially, this is in St. Louis, Holly Hills neighborhood, St. Louis. Again, South St. Louis, not north. So if anyone says St. Louis sounds great, avoid the north end, guys. You don't want it. You're not going to make any money there. So cash on cash, about 11.5%. Cash on cash in this one. So pretty good deal. Again, $300,000. We can get there within 12 months. So I'm just showing you guys 2 properties, right? That's we found $500,000 with 2 properties. So you guys see the potential here, and we're not even talking cash flow yet. Lot of opportunity. And so again, when people say, I don't know, it sounds like it's a lot of work. This is, and let me show you another one. First, let me talk about commercial financing 101. Again, I'm a big fan of multifamily, 5+ units. And first thing is loan amounts under $500,000, kind of difficult. So most commercial banks don't want to touch loan amounts under $500,000. It's not worth their time. And that's okay, because you guys are going to find investors and show you how to do it, and you're going to buy bigger deals. Number 2 is the terms depend on the seller financials. Most of the deals that I buy have crappy or like no financials. Maybe they have a rent roll, that 7 unit. They had 0 financials. They had a rent roll that was handwritten on a piece of paper. So, again, in my opinion, those are some of the best deals because the certain investors are going to say, I don't know what to do with this, I don't know how to analyze this, I'm not going to get financing, I'm not going to buy this. Those are the kind of deals that you guys want. If nobody else feels like they can figure it out or buy it, those are the kind of deals you want. So again, and also, by the way, there's no pre-approvals in commercial. So a lot of times when you talk to residential agents and say, are you pre-approved? Do you have a pre-approval letter? Guys, that does not exist in commercial. Typically, you write an LOI, letter of intent, to purchase the real estate, and then they sign that, and then they say it's subject to seller financials, right? You need a rent roll, you need a trailing 12 months of profit and loss statements. I want every single operating statement for 2 years. Sometimes I get them, sometimes I don't. What I do with that is I go through and I see all of the tenant log of who's the complainer in the complex, what are they complaining about. I can, through those operating statements, figure out if there's electrical issues, plumbing issues, if a tenant is just really super annoying, if there's a problem tenant in building who has paid late every month. It's amazing. So I ask for it. I would say about 75% of the time I get it, and then I know exactly what I'm getting into. I don't even have to go tour the property, right? All right, so bridge loans are for basically they're like short-term hard money loans, but with better terms. So bridge loans are going to be anywhere from the, I would say, 5% range right now. And then they offer lower rates but no prepayment penalties. So that's something that most residential investors aren't aware of. On the commercial side, they have prepayment penalties. Meaning if you pay the loan off earlier than the term that you agreed to, you got to pay a lot of money. And so you want to be kind of careful about that. Commercial appraisals start at about $3,000 and they take up to 5 weeks. So it takes a little bit longer. All right, so I want to give you guys some advice on the 3 best ways to structure your first deal. So number 1 is if you have the cash sitting around, buy it yourself, great. Or use your own 1031 funds, right? I love trading like duplexes in for 8, 12, 14, 16 units. Works really great. Number 2 is personally using other people's money. In my opinion, the best deal is when you own 100%, but you're using somebody else's money to buy right here. So I'll give you guys an example there. And then number 3 is if it's a really big deal, or maybe you're needing to bring in others to cover, the 4 areas of focus, you can joint venture with others. So this is a 6-unit that I bought. Purchase price was $415,000. Believe it or not, 6-unit built in 1995, Clarksville, Tennessee, 50% population growth, massive job growth. So I'm telling you all this because I don't want you to think you have to invest in like not great areas. There are great areas like this that you can find deals that really make sense. So I went to one of my private money lenders. I have a whole database of them. And I said, hey, could you finance, it's like 92% LTV, $385,000. I give pretty much every private lender 8%. I could negotiate better terms, but I love taking care of people, and why not? I did interest only 12-month note. So I put $30,000 down. Anyone on this call should have can find $30,000, guys. $30,000, and I put out of pocket about a $30,000 renovation. Which again, I could have had the private lender, but I just had extra money sitting around. I'm like, I'm not going to pay interest if I have money sitting in the bank. No, that's fine. So, anyways, then I went to a bank after I stabilized the property, purchased it, renovated it, put new tenants in. The bank appraised this property for $550. Got a loan for $425, paying the private money lender back. Plus, I put some more money in my pocket. I think I might have like 20 grand for this deal. It cash flows, I think about $1,700 a month. So guys, you could do this all day long. It is so incredibly easy to find investors that'll do 8% interest only for 12 months. Super easy. Super easy. And yeah, it's a really nice building. This one is I bought this in really late 2020. By the way, all these properties that I've shown, this is also in Clarksville. All of these properties that I've shown you, I've never flown out for an inspection. Some of these, I've never been to St. Louis, never been to Western Michigan. I'm buying these all sight unseen.
Just so you know, there's a question online that says, can 1031 deals be done between different states?
Yes.
Oh, absolutely. Yeah.
Just it's identifying if there's 45 days.
Just repeat that because you have a...
Yes. So the question was, can you do a 1031 in a different state? Absolutely. You can also do, they say like kind exchange, but you could trade in a duplex for vacant land, for triple net commercial, for anything that's an investment property. You just can't really 1031 into like a house that you're living in, right? You can't really 1031
Or
a house that you're living in. Thank you. Yes.
What's the biggest complex you own?
200 unit?
Oh my gosh.
Irving, Texas.
What are you comfortable with? Anything down?
Pretty much anything. So I love multifamily. Yeah. So I got a triple net deal that was like a Walmart with like another 10-year lease this morning, and it was a $9 million deal, and I was kind of looking at it, but I just love multifamily. Multifamily is my bread and butter.
Do you have a number, like you'd rather have bigger, or would you rather have a 6-plex or a 12-plex versus a 200-plex? Does that matter? I mean, it just all is the numbers,
Yeah.
or do you have a preference?
So I would say it doesn't really matter to me. So the question was, does the unit count matter? And so I would say back to that, it's kind of a different animal. Of course, we have employees, we have like leasing office, we've got, I would say, more issues in some ways, versus anything that is, almost anything that's 40 units and below, you're not going to have a leasing office, you're not going to have all of these other amenities, the
Who's
social
managing?
insurance, property managers.
Yeah.
Yeah.
So another question online is, who inspects these properties for you?
Inspectors.
Referred by
Yeah,
everyone.
so, sorry, the
Well,
question.
commercial property inspectors versus a residential property
Yes,
inspector.
yes. They call them third-party reports, but yeah, they're commercial property inspectors that are inspecting these properties. In addition to, of course, our real estate agents, we get videos. I have property managers that we want to hire on these properties show up, so I get their opinion, the inspector's opinion, the
And you're going in
agent's
every
opinion.
unit?
Oh, absolutely.
Yeah.
I have to go into every single unit. Yeah, we've had some tenants due to COVID, like I have COVID, you can't come in, and I send it back. Yes, always. Always.
Put on a hazmat suit.
Yes, always. All right, so JV partnerships. That's where you can partner with others to cover all of those 4 areas of focus. So again, let's say you're great at deal analysis and finding deals, and you're great at operations, but you don't have the capital and/or you're not financeable. Bring somebody in that can do those things. It's really, really easy to do. The majority of the equity, though, is going to come in the finding and underwriting deals, and the asset management, because that's like after the fact. So if you want like my feedback on how to really master this, master finding and underwriting deals. It's usually 2 to 6 people. You can divvy up the work and the capital. It's deal-specific splits. Always have an operating agreement created by an attorney. Don't DIY that. I set up all of my own entities myself, but in terms of if I'm partnering with anyone, always have an attorney draw that up. So here's an example. This is a 34-unit. Purchase price 1.6. Great loan terms in this one, 1.2. The down payment is $320 plus $125,000 in reno. This deal actually just died due to a $150,000 roof. I think it'll come back to me, but anyways, 50-50 split on equity and cash flow with an investor that had money sitting around and needed tax write-offs. High income earner, didn't know how to find deals. I would say pretty decent, maybe on the financing side, like they could get financing easy, knew nothing about operations asset management, but had like 0 tax write-offs. And so bring that person in on a 50-50 split for all of the capital, and then essentially they get the write-offs. I have no money into the deal and can essentially buy this 34 unit, put it into my operating system, and then there we go. So again, you guys can do this. Super easy to find these people to do that. All right, so I want to see if there's any questions, and then also invite you guys, we do an out-of-state investing consultation call. There's probably a lot of questions around like, well, where should I invest? Where do you find these deals? So we do that, my team does this every single, it's either Monday or Wednesdays depending on the week. So if you guys have additional questions about that, you can join that call. Otherwise you can ask me questions now, and I'm happy to answer. I don't know what we're doing for time, because we started like...
You're perfect.
I know. No, okay, so
Perfect to wrap up.
just you in general, do you invest in other people's deals? Number 1. And number 2, I know you do an investing group or whatever.
Yes.
You do some stuff. So,
Yeah.
I mean, and that's not why you're here to promote
No,
that.
I'm
But
just here
what,
to add value.
I mean, that's you're sharing here, but you have others to offer. So,
Yeah.
what is
Sure.
all that? Because
All right.
now I'm like, wait, what?
So question number 1 is, do I invest in other people's deals? So I do passively. So I have a whole like tax strategy, because I'm still a licensed real estate agent, right? And I run an S corp on all of my stuff aside from my real estate portfolio. And so I'd like to convert active income to passive income. So how I do that is I funnel that through my 401k, and then it has to be a passive investment. So through my 401k, I invest in other people's deals. And I private lend. So I'm a private lender as well. I think I did like 6 or 7 loans last year.
Okay.
So I love doing that. So if anyone's looking for a private lender, happy to
Do
help.
you JV?
Yes, yeah. So I will totally do JV. So if somebody finds a really great deal and they need capital or figuring out the financing, because the financing strategy, again, that's probably like a whole nother 1-hour conversation, structuring your financing, or operations, happy to do that. Always. Yes. Yep.
So would we bring you a deal, or are you sometimes looking for other people within a deal?
Both.
Okay.
Yes. Yeah.
And then you will help analyze the deal and
Yes.
say whether it's this is good, this is not good, this is why, everything else.
Yes.
Okay.
Yep. At minimum, I need a rent roll and a T12.
A rebel what?
A rent roll and a T12, a trailing 12 months.
Okay, yes.
Now, sometimes sellers don't want to release the T12. They'll say, I'll give you a rent roll, but I'm not going to give you a T12 until I have an offer. And that's okay. We just say, okay, great, you've got like 2 weeks to give us all of your financials. And then I negotiate where the timeline doesn't start until they give us the financials.
And that's just a net LOI.
Yeah.
Yes. Yeah.
So how do you analyze your places where you're willing to invest? Like Clarksville or that?
Yes.
So how do you,
Yes.
I mean, what's your criteria there?
Yeah, so the question was, how do I analyze where to invest? Number 1 is it has to have at least 20,000 in population. It has to be growing population, not declining. So like, I will get deals in Cleveland, in Detroit, in Birmingham, Little Rock, and it's like, nope, because more people are leaving those cities than are moving in.
Right.
And so to me, that's much riskier, right? And it's essentially like, I don't chase returns, I chase opportunity, meaning like opportunity to add value. And it's really hard to add value if you're trying to convince tenants to pay, if you're like trying to get tenants to pay, and the tenants aren't making enough to ever increase the wages. So I see a lot of investors say, well, it's a 10 cap. And it's like, but it's in the worst neighborhood. So the 10 cap on paper, but in reality,
you're going to have a hard time getting those tenants to pay rents. You're probably never going to be able to increase rents, which means you're never going to be able to increase the value of the property, which means you're never going to get your money back.
Well, so with that being said, you spoke of St. Louis specifically,
Yes.
where you said south, not north.
Yes.
So then if, you're in a city, then how are you then analyzing that part of it then?
Yeah. So a lot of times that comes from the commercial brokers.
Okay.
Yep. So funny story. So like a couple of months ago, I was like, yeah, I don't like St. Louis, and the commercial brokers, I bet you're looking at the wrong St. Louis. I said, well, tell me more. And he showed me. He said, well, people are moving here, but not moving there. So essentially, they're coming from the north into the south. And then, I did the research and said, okay, that's right. And I see the appreciation there. Yep.
Do you strictly do multifamily?
Pretty much at this point, yeah, multifamily. Yeah. I mean, if a great fourplex comes, like I wrote an offer on a fourplex maybe 2 weeks ago. And it was in Winston-Salem, North Carolina, which has massive population growth, great rent appreciation. It was a fourplex built in 1986 for $230. I'm like, I said, no, right away.
Yeah.
So when I say strictly multifamily, yes. But if somebody brings me a really great deal,
Right. And multifamily is technically 5 units and up.
yes, yes. But yeah, so I'll buy residential, I'll get a commercial loan on it, because at this point, like, I have too many loans, and I won't even go through the headache of doing conventional loans. It's a nightmare. Plus, commercial rates are typically lower than conventional.
Right.
So a lot of times people think the opposite. But if conventional is probably 5.5 today, commercial, when I was talking to my commercial broker the other day, it's like 4.1. So a lot better terms on commercial, but you just have to know your strategy, because you're gonna have to refinance in a couple of years. So that's why you don't want to be buying in areas where more people are leaving, because you have that 3, 5, 7 years, right? And so if people are leaving and you're having a hard time getting tenants to pay, and you have to refinance in 5 years, that's a big risk, right? You might have to bring money to the table at the refinance versus getting money at the table.
Right.
And that's the difference between markets. Yeah.
So do you have a class? I mean, it looks like these are a little bit more B and C, maybe, or is there
Yeah.
just a matter of
Yeah.
everything?
So I have some A class. So I used to do build to rent in Seattle. And so like, in my opinion, the Phoenix Metro build to rent is like the key strategy, or short term rental. It's really tough to get really any kind of cash flow in this market based on the price per unit and the actual price to rent ratio. A lot of syndicators I'm noticing are like buying units, and then they're not cash flowing, but then they're paying all the investors back because the prices are going up.
Yeah.
And that works when the cap rates are really low and there's a high demand. It doesn't work if the cap rates go up, right? And then essentially you have all these investors to pay back, and you don't have an exit strategy. And I think that at some point that's going to come to a head, because we've had a very long run of really low cap rates and everyone going in because there's really great terms. And with those interest rates rising, I'm actually kind of excited about that, because it's going to put some of those syndicators out of business. And some of those investors that are like, maybe, everyone looks like a genius. Anyone that's been investing over the last, I'd say, 3 years looks like a genius. But when those interest rates come up, it's like there's more stress in the deal and on the underwriting. And so we're going to see a lot of people probably get out or pause or wait for the next recession, whenever that will come. And then that's when the opportunity will be had. Kind of like, I would say like March of 2020, I had so many investors, so I do a coaching program for investors. I had so many investors that were under contract in apartment complexes calling me like, should I bail? Should I bail? Oh my gosh, the sky is falling, there's a global pandemic, I think the real estate market's going to take a hit, should I just bail out of this deal? And so we had a lot of conversations on like, well, okay, let's like put that aside and tell me about the deal. How does this cash flow? What's the tenant population? What the jobs look like? What's the appreciation in the area? So everyone stayed. And then there was like maybe 2 months of a recession. You guys know, but there's like 2 months where everyone's like, I don't know, it's gonna go, it's gonna go. And then it shot right up. And a lot of those investors have now doubled their portfolio value, because they were able to kind of set aside the emotion and the media and everything that was like the sky is falling. And so that would be like also my advice is ignore any kind of media message, ignore what people are saying.
Yes, with the
I'm
interest
going to have
rates
you
rising, what do
say
you do?
goodbye online, and we can
Oh.
continue the conversation.
Thanks, guys.
Bye.
Bye.